Hi everyone, this is Balaji Kastel. I've been in the stock market for last 20 years, and out of the 20 years, 18 years and 19 years almost, I'm studying this Warren Buffett, one of the legendary investor in the world. And from he started from nowhere, but over the period of time, he mastered the game of investment, and he got be mentored by right people like Benjamin Graham, Charlie Munger, and that made him one of the greatest investor and build the investor turned to a businessman and also philanthropist in the world. Does the investment and he has done the. I studied him very well because 2005, since 2005, I know I was looking at his annual reports, his letters to the shareholders, letter to the partners, and all those things, videos, etc. That inspired me to write, the first book also, which is hit number one in USA, multiple categories, investment and private equity. The book is Intelligent Investors, a Mistake, Warren Buffett. Today we are going to see what is the best we can learn in short period of time. I decoded him from his beginning and what he does, the way he does the investment now. And I hope this video will help you to crystallize your own investment framework. Let us start without wasting much time. What we learn today is what is value investment, right? The multiple definition of value investment pulled, when they started almost 100 years back. But today we'll see specifically the Warren Buffett way, right? And I'm going to discuss the three simple steps, the way he decodes the catch wonderful business as book for investment. And also going to share my own practical steps for quickly, and there will be bonus tips, how common mistakes to avoid, because the ultimate way is to avoid the mistakes in the investment, and we have to learn the mistakes from others so that we'll do minimum, it will not cost us in terms of money and time also. Just before, we should understand why most investors fail. In fact, I will not say investors, I will say participant, because in a lot of people say investors, but they do trading, speculation, and other things. Right? Investor has a specific meaning. Why most investors fail? Right? First, they try to chase the trends without any value. They follow all technical parameters and other things without understanding what is underlying business, what is behind that number which is sticking on the stock market prices. They may, as a follower trading, etc., they might be able to do money once a while, but consistently, I haven't seen money making over the period of time, and they're just thinking more and more transactions they're doing. But if you see the amount of money they're going to get, the wealth they're going to accumulate is very, it doesn't make any sense putting so much effort and time of your life and working for so much little gains. Second is ignoring business fundamentals, not understanding the business, what is the underlying business, how is working, is it going to make a profit, because fundamentally you have to understand how the stock market works. The underlying business, when performs very well, the stock market prices has to follow what is business is doing. It's doing very well, it's growing very well, the prices has to follow. That's a fundamental thing you have to understand very well. And third, as human, all humans are, we are emotional. We take emotional decisions in life and try to find shortcuts. Fear, greed is there, envy, a lot of our own biases. Everyone has his own biases, including myself. Fourth is speculation. Right, people get into very quickly speculation things because of just listening to some hot tip or some news, etc. But without following their own system. Just these are the major reasons I see investment fail. Causes cost to you your money and your time. Let us see what is the value investing in Warren Buffett way. The Warren Buffett very well is said, price is what you pay, value what you get. Right, this is very deep meaning it has, and he has said it in very beautifully in single sentence. The actually we are putting the price. All right, we are buying in stock, but we have to expect the value. All right, and we are going to see in this video how we are going to get value and what should we be looking for it. And fundamentally, if you see what is investment is very simple. You have to put something money in market or any securities, with the having with the higher degree of certainty that is going to get more money out of that, right? Otherwise, it doesn't make any sense putting any money in stock market or FDs or any other things, right? That is the main crux you have to understand. And that's obviously he said very well. The price, what you pay, value, what you get. Suppose someone is offering you 100 rupees at the price of 70 rupees, say, right? That means of course you are going to take. You are not going to deny, right? In capitalism, you have to understand where are these kind of opportunities are available for us, and make the advantage of those things. That is the value. That's the crux of the value investing. Value. We're going to get the businesses at the business value and the market price. The same thing termed as a margin of safety by Benjamin Graham. He was a mentor, and in many terms, he is taken as a father of value investing. We are going to understand what is the margin of safety in the subsequent slides. Okay, now let us come to the core of this presentation, where three simple steps to invest in the stock market by Warren Buffett. First, we have to understand the business, right? Second is the promoter, and third is the valuation or value with the margin of safety. These are the factors which are the very simple steps we have to follow. If we broke down in first step, start with the business analysis. We have to understand the business, what business is doing, company is doing. Okay. Second, once you are comfortable with the business, you understand what business is doing, what is the way it has to growing, and what is expected, how it is going to evolve over the period of time in the market scenario. Second, we have to see the promoters. We have to evaluate. We have to look at the promoters who are assessing their leadership and management style, the way managing the businesses, and how they're taking everyone together, including employees and all their suppliers as well as the shareholders view, right? It shows their ability and attitude, right? These are the I'll not say only management. We have to think them as partners, right? In fact, they also be reciprocally thinking as a partner rather than burden on them, right? Third is value, margin of safety to you, because even if things go wrong because of XYZ reason in the business or the person or in our own evaluation of that, we should be protected at the downside, right? Therefore, we should be demanding, in fact, the margin of safety. Now, let us go one by one in detail about the business. The business, if you understand the business, you understand the investment. It's a very beautiful sentence by Warren Buffett. If you understand the business, you, right? A person does the business, right? Business they does to put what is doing is effort putting for people or doing the things. He is expecting more than that. The same way in the investment also, as I said earlier, we have to see how the business to the investment going to return us more money what you're going to get, right? That's a fundamental thing in the investment, and I'll say specifically in terms of value investment. And if you decode it further, it's the certainty. Okay, the certainty at which the business economics will going to you are able to evaluate. And if you further decode his sentence, the certainty at which the business economy is going to evolve and going to generate the wealth for us, right? That we have to very crux of the this investment philosophy. In that, what is a business model, right? Therefore we have to understand the business model. Everyone has an understanding of the different businesses they understand, because of their background, their understanding the studies they done, they even know their own businesses. It's very simple. First business model is the we have to see is the any business has any pricing power, right? Are they able to govern any pricing power? They have some kind of monopoly businesses, right? Because there's no business or no services or product is available which people are willing it, and people has to go and buy it again and again, right? The brand value itself, right? What is the brand value means? The brand pull is so much that the people are going to get those businesses. Like you see in India, the kind of you see a Tata brand or a Titan or Tanish, the purity will be there, the service will be there, and we trust that we go by. Even if they're charging more than that, any other local or even if any local jeweler charging more a little less, but still we go to the buying more Tanish because the trust and the varieties and service we're going to get with those brands, right? There is also third is the upselling and cross-selling. What that means is people are coming with the different. There a lot of people are there with the they're buying some supposing simple. Take an example of maybe buying someone is buying maybe a basic washing machine on a top loaded, which is a very entry level. But over the period of time, he or she might be like to upgrade to the front load, which is a more premium and more effective, right? If the pricing will be increased, but the service also going to increase. Therefore, we have to see the businesses which have opportunity to sell not only the basic product, but how they can sell higher end product. It's called upselling, right? And cross selling also. For example, to see even example of Apple. right? Apple phones, they're not only selling Apple phones, they're cross-selling multiple accessories of Apple's, right? It's earpods, right? And the laptops, all those things will come into picture as a whole economic or digital ecosystem they're making as cross-selling across to catering to the different consumers and different price points. And fourth, you have to see agility of the business. How the business is agile in terms of how quickly they can modify as because some market scenario changes or demand changes or the costing pricing of the raw material, etc. Next is the stickiness, right? Suppose if you buy some product for the service, you have to keep buying it since service or some accessory from them only, right? That's about stickiness of the customers. It happens typically in the B2B, in consumer also. Goods, if you bought some washing machines, if they happen, you have to buy the spare parts from them only. That's called stickiness. uh, Next one is the capital requirement. We see in the stock market, big companies are there, but they're very capital consuming, right? Any do upscale or expansion, etc., they have to put a lot of capital, right? It's a cost to everyone. It's a cost to the business and the shareholders. You have to understand how minimum capital company is using but generating more and more wealth for them. If you put in simple words, suppose you're putting 100 rupees, how is easily able to generate 120 rupees for 140 rupees, 200 or 500. Suppose today is making 100 crore, but after 1 year down the line, it has to make 200 crore. So how much money it has to put to expand in the business or the new product or new services, right? It is called, uh, you know, the capital requirement, right? We see a lot of the heavy industries need high capitals because they have to handle the more physics. They have to handle more physical goods and heavy goods, and it's increasing all supply chain costing for them. Also, last I'll say is a cost advantage, because if you are suppose typically this happens in a lastly is a cost advantage. Does this company or business which is doing as a cost advantage? Like if this is steel maker, does they own the raw material, iron ore and coal, etc. Those mine linkages there, they are near the those sources, so that they can the transportation cost will be low and they can produce it more efficiently. Because the prices more or less remain as the commodities, the prices remain the more or less the same. But you have to see how effectively or cost effectively they can generate the products and deliver the goods, so that they can maintain superior margins. Also, if you have to see the once you understand the business, and so how is business model, how is working, you have to see look at the historical financial strength. The historical is a rarer view, but it's important to understand how the trend is happening. How this will help us to understand how certainly we can see the future also be more like the same way. First is the sales and how sales and profit is growing last 5 years, and so return on equity. What is return on equity is the actually is the measure of profitability of the business in relation to the equity. How much net income is coming for a given equity. Typically, you should be expecting a return on equity more than 50% when you are rating. Second is a very important parameter is the return on capital employed. It is a measure of profitability of a business after taking all their expenses in account, right? And that's why I just mentioned in the last slide. What is the how much capital is taking? Minimum capital is taking, but generating more and more profit, right? That's the capital requirement, and we should be expecting a return on capital employed more than 50%, 70%, over the period of time, and it has to maintain its consistency. And also we have to look for the businesses which are low debt typically, or no nil debt, because anything goes in the higher inflation time or higher interest rate is going to affect their profitability. Of course, we have to see the next if the stable margin is there, right? And there is a positive cash flow, right? You have to understand cash flow is not a profit before tax which I look after, but cash flow you have to see the actual cash flow is happening to the from the operations to the business. It should be positive. Once a while maybe it goes here and there because of some external events, or maybe it's own their expansion, etc. But at the end of the day, we have to see it is be generating more and more cash what is keeping inside. Second important in the Buffett filter is the promoter's ability and attitude, right? The certainty at which the we can judge the management ability and attitude. No, we have to understand them, how they're carrying out the business, right? How much they have a holding in the company. Typically, I say more than 45-50% should be there in the stock market in the as a shareholding pattern. It shows their commitment or skill in the game. Also, we have to see how effectively they allocate the capital, how much they give the importance to expansion, which product line, right, which is generating more profit. And also, you have to see how much transparent they're making the reporting in annual reports, in other disclosures which has mandatory by the governments. And next we have to see the characteristics also, how they're behaving, how they're talking. Are they over promising every time and talking, higher things rather than delivering those results over the period of time? And we have to avoid typically the promoters which are dilution, which is doing dilution, consistently raising the fund, say in terms of to pay off the loans, saying working capital adjustment. It shows inefficiency, and therefore to generate the cash, they have to dilute the shareholding in terms of we are going to dilute it our own self, right? Are they pledging the shares of the company to get the loans? And it's very important is lastly I say we have to very cautiously see related party transactions. I see in all the businesses we have to understand how the money is flowing, how they many times I seen the promoters have multiple businesses, and they're taking the money from the main listed company to the fund to their private businesses or private interest. Right, we have to understand those very well, and we have to see in short. I'll say we have to see their ability in terms of their experience, right? How they understand market dynamics in the business they are in, and how they're handling it in terms of capital allocation. And second is the attitude. Attitude is comes from their how they are treating the different law of the land, right? Governance and the shareholders, right? And sharing the profit with the shareholders people very well. I see a lot of companies they say we are not. I see a lot of companies they say they don't give the dividend because to preserve the cash. But you see, but consistently they're increasing their own salaries and bonuses, right? And those things doesn't go in sync. We have to be very careful by understanding by evaluating their annual report. And third, I say is we have to see valuation, right? So investing is I'll say is a game of valuation. So if I'm going to decode it a bit more here, the price is what you pay, value what you get, right? As you seen one word says, valuation is the process of estimating is actual business worth in terms of how much is going to help, uh, how much is going to generate the wealth for the investors. A good business bought at wrong price is still a bad business, right? Your business may be good and then you're doing it, you're growing it, but you bought at very high price. At that time, you haven't done the right valuation and you got down. In that case, you might be making some profit, but not as much money you should be making actually in the profit in the stock market. Let us see what is intrinsic value versus market price, which I'm talking about the marginal safety. Intrinsic value is based on this fundamentals, how much cash is producing. That's one way to look at it. Second, it is also you have the how much asset it owns, right? That gives its intrinsic value. What that means is suppose a real estate business is there, we can know what is that how much real estate owns at which place, what is value. Or the bank is there, how much asset like loans it has given, that is this asset, right? These are the determine their actual intrinsic value. Secondly, the market price is available and it fluctuates daily based on the sentiment in the market and the news and all those type of things. And as a investor, your main goal is to buy, these businesses, the businesses which are available at the intrinsic, below the intrinsic value, so that there'll be sufficient margin of safety, as I shown in this graph. The blue line is the actual value of the business. It may be increasing or maybe some once a while goes down because of XYZ reason, something bad happening to the business. But the stock price is we see is very more fluctuating, right? Because of sentiment of the people. And the gap, I just shown as marginal safety, that time you have to then see the price is going very well below, right, of the actual business value, maybe 25%, 30% and more. At that time is a time for you to buy those businesses, right? And if you are those business, as I said, it's wonderful. As I Warren Buffett very well says, those businesses which are wonderful businesses at wonderful price and with the partners as a promoter as a partner really make a great combination to own those investments. The margin of safety, as I said, is more than 20, 25, 30%. Should be discounted to the intrinsic value. It gives the cushions even if it do some errors. If it goes down, you can quickly correct it without much loss. Or something unknown risk, right? Maybe market itself has behaved very badly, and the business is not doing very well, and the promoter has done wrong bets. Although all those things can be taken care of with the proper margin of safety. Uh, Actually, I say valuation is not about finding cheap stocks. It is about finding businesses at the right price that leaves room for errors and room for growth. Right? It's very important. Therefore, as an investor, we should be demanding the margin of safety in the investment so that you can protect your downside and maximize your upside. I hope you are learning a lot of things in this video. I'll say this is a crash course on decoding Warren Buffett's value investment. Next, I'd like to share with you the practical steps in the identifying a wonderful business in the stock market. First, the quick checklist is return investment of the business should be more than 15%. Okay, we have to see over the trend in last 5 years, 10 years, and the promoter holding should be very well, and the promoter should be, we should be, as I said, its ability and attitude should be very well. We should think them as a partners, right? The debt should be nil or less than 0.5% of the total asset of the business. Price should be less than the intrinsic value. Okay, the gap should be more than 25% and so forth. And higher the gap, that will better the return you're going to make over the period of time. These are the practical, very simple steps I have given for you to do investment. And the bonus I like to mention is a common mistake. All investors does the mistakes, right? Even Warren Buffett has done his own set of mistakes in his own overall investment journey. I did also did a lot of mistakes, but point is we have to do minimum the mistakes, or we have to learn. Ideally, we have to learn mistakes others what are doing it by observing them, by studying them, by learning them. Right? That is quickly you can learn yourself and start your journey with kickstart. And even if you does any mistakes, because of unknowingly, you have to you have to show the humility to correct it immediately so that you can move forward. The common mistakes which I say is the not buying all the tips, right? Nowadays, because of a lot of tips in social media groups or online news, etc. Avoid the tips that will just make you not knowing is it right for you or not. Right? Therefore, I insist on the do your own research that help you. And there is not having proper margin of safety is one of the I see. Just people are prices are going high and getting more media coverage. Just get attracted. Just remember, when prices are going high, your margin of safety going to reduce, right, and increasing the risk for losing the money, right. Next is the not studying the business. I humbly request everyone to study the business, understand the business, then only take the decision or own decision. The independence of your decision making, making real wealth for you, make you confidence that this business is good or not. If it's good, then you just ignore the market prices, and if it goes very well low, in fact you buy more, right? That is a key to the accumulate your wealth. Next mistake people do, not evaluating the management properly. Just just I think as prices are going high, the business is doing good, but if management is not ethical, they're not sharing the wealth with you, then it's not going to make sense for you as a business owner or investor. And next one is the emotional. Emotion, as a human, all has emotions, and they exist based on emotions when price crashes. All right, but as long as you've done your homework, and as long as you're confident on the business, and the lower the price is better for you, can buy more, share of the business, right? These are the common mistakes I'll say. Mistakes are very important to study. That's why I written a complete book on the mistakes, the intelligent investors mistakes, Warren Buffett. I captured all the mistakes of Warren Buffett, what he does over a period of time in the book. You can get the link below in the video. You can leverage on those mistakes and move forward faster pace. In summary, focus on the business, management, and valuation. Okay, that is very 3 simple steps for any value investment investor has to do while doing the investment over the period of time. And this is sure shot that you are going to generate the wealth for yourself and your family. And always demand the margin of safety, as I said, and think like an owner, not a speculator, right? When you're owning, when you're buying something, you should be thinking thoroughly the way, for example, you're buying a car, or like a refrigerator, television, how much everything you should be in fact doing more work here, analyzing the things and understanding the businesses, the management and its value, right? And at that time, this is sure short formula to build the wealth the way I did it, the way Warren Buffett has done, and a lot of people across globe, done by following the value investment. That is ultimate way to generate the wealth for you and your family. I hope this video has given you insights and how Warren Buffett has generated the wealth, how he's followed the value investment, and I encourage you really follow these steps to help you. I understand this is some work is involved, but the magic here is once you do your homework properly, then no need to repeat because the future things are only incremental, right? Just what happened to the business, etc. But if you do your homework once, understanding the business properly, management evaluation, and value of the business, then the game is very simple, and that will make you wealthy. And not only wealthy, it will make you a legacy for to leave behind for you. I hope this video has helped you, and please share your comments and share this video who are interested to learn the value investment and grow wealth for you. And they thank you for sharing this video because they learn faster way. Thank you.